Hello and welcome to this morning's session hosted by the Myerson Banking Sector team. Today we'll be looking at what to consider when approaching a refinance, with a particular focus on refinancing a property facility. The talk today will be given by myself, Ryan Fletcher. I'm a senior associate in the corporate team, and I also lead the Myerson Banking Sector team. My colleague Charlotte Hook is a senior associate in the real estate team and a member of the Myerson Banking Sector team. Both Charlotte and I regularly act for owner-managed businesses and high net worth individuals on a range of corporate, real estate, and banking matters, including refinancing projects. Charlotte and I have acted for a number of clients in relation to initial financing and refinancing arrangements, with Charlotte focusing on the property-specific aspects of such refinancing, whilst I act on the banking-specific aspects, such as the loan facility agreement and the associated security arrangements. So, for the purposes of today's session, we'll discuss matters on a general basis, as time won't allow us to go into detail on all relevant points. Our contact details will be on the screen at the end of the presentation, so please do get in touch should you wish to discuss any of the points raised in today's session in more detail. Now, no doubt everyone in attendance is aware of what a refinance is, so in brief, when approaching a refinance, there has to be a pre-existing debt arrangement with a lender, which, for one reason or another, is to be repaid using another tranche of debt, either from the same lender or a new lender. The purpose of this webinar is to give you an overview of what you should consider when approaching a refinance, and that will include professional support and what you can do to prepare, a review of the legal process, which will include the key items you should consider when negotiating a refinance. And finally, we'll briefly discuss some case studies of refinancing matters that Myerson has assisted with. So there are a few reasons as to why you would look to refinance. The obvious reason to refinance is that the fixed term of the loan is coming to an end, meaning that the current loan is due to be repaid. Now, it's often the case that in such circumstances, the borrower doesn't have the liquid funds to use to repay the outstanding debt, or otherwise doesn't want to lock up their cash by repaying the lender and would rather reinvest that into the business. As such, it's necessary to refinance either with the current lender on new terms or with a new lender. In a similar vein, it may be the case that there is a need for capital within the business, either to fund new acquisitions, development costs, or simply to invest in other resources the business may need, for instance, funding more staff, better equipment, or to act as general working capital, and therefore the refinance is to increase access to that capital. Refinancing can enable this to occur, particularly if the underlying value of the business has increased since the last financing was taken out due to perhaps an increase in its property holdings or higher than expected performance. This may enable you to refinance and borrow more under the new arrangement than was due under the current financing. Another reason that you may look to refinance is interest rate fluctuations. So the days of cheap access to capital seem to be gone, at least for now, and we've all seen the volatility in interest rates over the past few years. It may be the case that the current rate of interest under your facility is no longer commercially viable, either because it's perhaps a fixed rate, and that rate is above the current interest rate that's available on the market, or it was fixed at a lower rate and this fixed rate period is coming to an end. It could also be the case that the margin that's being added to the relevant reference rate that's used to calculate interest is now too high, and that's causing working capital and cash flow issues. In those circumstances, you may look to refinance in order to get a better or more appropriate rate of interest. Finally, you may simply be looking to renegotiate the terms of the loan. This may be for a few reasons. It may be that since the original financing, the borrower is in a better position, either due to the financial performance of the business or an increase in the underlying value of its assets. The loan principal would also have decreased in the intervening period, and that obviously assuming the facility requires capital repayments to be made during the term of the loan, not just interest payments. And in those circumstances, that would mean that the borrower may now have improved covenant strength and so be able to negotiate better terms. For example, the loan to value of the borrower may have materially decreased, meaning further capital may be capable of being accessed. The flip side of having to renegotiate the terms of the loan is that perhaps performance has fallen below expectation levels, and so it's necessary to refinance to alleviate some terms in the current arrangements which are causing issues. For instance, if compliance with certain financial covenants is causing cash flow issues. So, having briefly covered the initial points around why you may consider a refinance, I'll hand over to my colleague Charlotte to discuss how you can prepare for a refinance and what professional advice should be sought in relation to it.
Thanks, Ryan, and good morning to everybody who's joining us today. So, if you're the borrower, one of the first advisors that you should talk to is your mortgage broker. You should discuss with them what you're planning to do and why, and they'll be able to give you some advice on what type of financing you'll need and what your options are. Your mortgage broker will be involved throughout the transaction, linking up with your lender and your solicitor to make sure everything runs smoothly. You should also speak to your accountant to discuss your intention to refinance, and they'll be able to advise you on the financial and tax implications. You might also need them to assist with your application to the lender, as the lender might ask for financial statements and copies of accounts. You should try and instruct your solicitor as soon as you know which lender you're going to be using, so they can start gathering all the documentation that's going to be required as part of the due diligence process for the lender. We'll come on to discuss the due diligence process a bit later in the webinar. It's important that there's enough time to deal with the lender's requirements before any deadline. For example, the expiry of the term of the existing loan. So the sooner you instruct your solicitor, the better. You might also need some assistance from your insurance broker. The reinstatement value for the property on the building insurance may need increasing to reflect the reinstatement value in the valuation that the lender conducts on the property. It's also likely that the lender will want their interest to be noted on the insurance policy, so you'll have to request amendments to the policy from your insurance broker. It will be helpful if you can gather the relevant planning permissions and building regulation certificates for the construction of the property and any alterations if you have these available, and also the planning permission for the current use of the property. You'll also need to make sure that you have all of the documents available relating to any tenancies of the property, including leases and ancillary documents. For example, any deeds of variation, licenses to alter, rent deposit deeds, and rent review addendums. So I'm going to hand back to Ryan now, who's going to talk about the practical aspects of the refinancing process.
Thanks, Charlotte. So now that we've covered off those initial points, we'll consider what the refinancing process may actually entail over the course of the next few slides. So as per the notes on the screen, we'll consider the finance and security documents, and that will include the initial term sheet, the facility agreement documenting the loan, and the associated security documents. We'll consider financial covenants, which are used by the lender to measure your risk as a borrower and test that risk throughout the term of the loan. We'll consider conditions precedent and subsequent, which is what will need to be satisfied before the loan can be advanced, and what will have to be satisfied following its advance, and also when. Charlotte will then consider property due diligence and what the lender's solicitor will consider from a property perspective, including title searches and inquiries. And then finally, Charlotte will have a look at the additional steps required when the refinancing specifically relates to a development. So the first document we'll consider is the term sheet. Now, this is usually negotiated directly with the lender initially, but legal advice should be sought once negotiations of the commercial aspects have progressed and before the terms are finalised. Now, whilst the term sheet will not be legally binding, this is the document that will be used by respective lawyers to draft and negotiate the terms of the legal documents. So it's important to get the contents right to avoid having to renegotiate the heads during the course of negotiating the facility, as that will inevitably add to the time required to negotiate and so likely increase professional costs of all parties. The term sheet can cover a number of matters and is very deal specific, but some examples of what it can include would be the details of the borrowers and any guarantors, along with the form of guarantees to be provided. It would usually confirm the type of the facility that's being advanced. So, for instance, is it a term loan? Is it a revolving credit facility? And so on. It will, of course, confirm the amount of the facility, along with the bank's fees, if any, such as an arrangement fee. A term sheet would confirm what the agreed use of the loan is, and this is obviously important. So, for instance, is it to acquire property? Is it simply to refinance existing debt in relation to a property portfolio? Or is it to fund the development of one or more properties? The term sheet will confirm the term of the loan. So, in other words, how long do you have until it needs to be repaid? It will confirm how the loan can be drawn down. So, is it all drawn immediately on completion? Is it drawn in tranches? Once drawn, can it be repaid and redrawn? And so on. A term sheet will confirm the interest terms, and that will include what the reference rate is for interest. So, is that base rate? Is it the sterling overnight index average? And so on. And it will also confirm the margin that will be charged over that rate. Again, those are commercial points, but should be considered. What are the repayment terms will also be covered. So is it repaid monthly, quarterly, annually, or is it interest only and repayable in a single bullet payment at the end of the term? Finally, it will also confirm what financial covenants will be required. So for instance, loan to value, gross development value, interest cover, and so on, which we'll come on to shortly. So the next documents to consider are the facility agreement and then also the associated security documents. Now, the facility agreement is the key document as it will contain all of the main terms relating to the refinance. A facility agreement is sometimes referred to interchangeably as a loan agreement, but they both do the same thing. The agreement will cover off all of the points mentioned on the previous slide that were in the term sheet, but obviously in more detail. And as ever with legal documents, the devil is in the detail. The content of the agreement will be influenced by the type of the facility. So, for instance, is it a term loan? Is it a revolving facility? Can it be extended over time, which is sometimes referred to as an accordion facility, or some or all of these forms of facility? It will also be influenced by the nature of the borrower. So, for instance, are they a property portfolio landlord? Are they a developer? In addition to the items mentioned on the previous slide that will be covered off in a term sheet, a facility agreement would include those along with some extra points. So, for instance, it would include covenants, which are financial promises by the borrower to do or not do something, and that would importantly include a negative pledge in relation to the borrower's assets charged to the lender under the security. It would also include warranties and representations, and those are statements of facts in relation to the borrower, its assets, its financial condition, and those are usually repeated at agreed intervals by reference to the facts at that time. If a warranty or a representation is incorrect, this would be a breach and an event of default. So it's important to ensure they are not only capable of compliance at the outset of the term, but also throughout the term. As just mentioned, events of default would also be included within the facility agreement, and that will confirm the circumstances in which the bank can enforce the loan, and if they do, other provisions in the facility agreement will confirm what actions the bank can take in such circumstances. So that would include things like, can the bank take control of assets, appoint a receiver, appoint an administrator, and so on. So that's a real whistle-stop tour over a facility agreement. Turning to the security documents, the type of documents that will be required will always be deal specific, but in the context of a property refinance by a corporate entity, it's highly likely that this would include a debenture, which would contain fixed and floating charges over all assets of the borrower, including its property, but it's worth noting a debenture wouldn't be limited to just the property. A bank may also require a separate legal charge to be provided by the borrower in relation to each property, and that would overlap to an extent with security provided by a debenture. Both forms of security would be negotiated alongside the terms of the facilities agreement. So, whilst there is often only limited scope to negotiate security documentation, it is important that they are negotiated to fit the circumstances of your business and the wider deal. It is often the case that borrowers assume security is a one-size-fits-all, take it or leave it, but security documents are often drafted very widely and in favour of a lender, and it's likely they will need to be negotiated to reflect your specific requirements. So, for instance, should certain assets be carved out from the scope of the security, either in full or in part, or should certain controls of the bank be suspended or not apply at all, or if they were to apply, should they only apply if a default occurs? Each deal will ultimately turn on its own circumstances. Some additional security documents that the lender may require could include a guarantee, either from the members of the borrower's group, if it's a company, or from individual shareholders or directors. If personal security is sought in the form of a personal guarantee, the bank may also include a charge over shares from shareholders to capture their interest in the borrower, which would effectively enable the bank to take ownership of the borrower should a default occur. Our advice is always to be wary of personal guarantees. Assuming the borrowing is refinance properties, the bank will have a reasonable amount of debt coverage from this alone. If it's absolutely necessary to provide a guarantee, it should be limited in scope and capped at an amount which is less than the total amount borrowed. So now we turn to the financial covenants. Many loan agreements and all large or complex loan agreements, so for instance, those that are on LMA terms, will include financial covenants, which are formulas based on pre-agreed metrics against which the bank will measure compliance. The borrower will undertake to comply with the financial covenants throughout the term of the loan, and compliance will be measured at a pre-agreed frequency. That's often quarterly and on the occurrence of certain events. So, for instance, further utilizations or drawdown of the facility or a prepayment of the facility. This measurement then acts as an early warning sign for the lender that the loan may be a default risk if it shows there is non-compliance with the financial covenants. Financial covenants are often one of the most carefully negotiated elements of a facility agreement. This is sometimes due to them just simply being overlooked by borrowers when negotiating initial terms with the bank, and them only being considered fully at a later stage once legal teams become involved. If there's one thing to take away today, it's don't make the mistake of overlooking financial covenants at an early stage. So on the screen, there are a few covenants that we can run through. Now, again, what covenants apply will be very deal specific. So these are just some examples of what you may see. In relation to loan to value or LTV, in almost all circumstances, any property financing or refinancing will consider loan to value. This is the easiest metric for a bank to consider and continue to measure its risk in the context of property, assuming it's not for development. This will consider what's the amount of the loan against the current market value of the underlying property. A bank will agree a certain percentage against which the loan mustn't exceed. So, for instance, 60% or, as per on the screen, 75%. The way to measure this is that the lower the LTV is, the better the borrower's covenant strength. So lenders will often provide better terms to borrowers with a lower LTV. Loan to gross development value is used in slightly different contexts. So for developers, an LTV covenant may not be appropriate, as the value of property may be much lower at present than it will be in the future once the development is complete. So the lender is funding the development, and so a relevant metric, amongst some others, is to measure the loan to gross development value. This measures the anticipated market value of a property once all development works are complete against the total amount of the loan. It should be noted that this is usually the total loan available, not just the proportion of the loan that has actually been utilised. If you are a developer, this is likely to be more appropriate than an LTV covenant. Finally, we'll just quickly have a look at interest cover and capital cover in the context of financial covenants. So, an interest cover covenant usually measures an agreed metric against a percentage of the interest payable in a period of time. So, for instance, as per the example on the screen, it could be rental income for a 12-month period against the interest payable during that period. Capital cover is similar to interest in that a capital cover covenant will measure an agreed metric against a percentage of the capital repayable in an agreed period. So again, using the example on the screen, it could be rental income over a 12-month period. So finally, the last point on the financial covenants, you may be thinking, well, what's the consequence of a breach? Well, a breach of a financial covenant is on paper an event of default, and that would entitle the lender to enforce its security. What often happens is that an initial financial covenant breach is a red flag for the bank, and that may initiate discussions with the borrower about what could be done to rectify this. Now, sometimes this may result in operational decisions being made by the borrower at the bank's request, which may be backed up by a revised business plan or financial forecasts. It may also result in a renegotiation of some of the loan terms. So, for instance, amending the scope of the financial covenants or altering the term, capital, or interest payments. It's often the case that enforcement won't occur until there are ongoing breaches of financial covenants, though this ultimately does depend upon the lender and the wider market position. So, for instance, if there were to be a market downturn, banks typically become stricter around enforcement. So finally, the last slide from me before I hand back to Charlotte is a brief overview of conditions precedent and conditions subsequent. So the point to note with conditions precedents is that they are conditions that need to be satisfied before the facility will be completed. This will usually require a high volume of documentation to be provided to the lender, and that will require your input. So for instance, it could include the provision of a business plan, which will obviously take time to prepare. It will include cash flow forecasts, budgets, agreeing documents with third parties, such as managing or letting agents, if relevant. So, for instance, if the refinance relates to a buy-to-let property portfolio. It could also include insurance documents and reliance letters from your insurance broker, and they do usually have a lead time of several weeks. It may also include valuations and a high volume of property documentation, which Charlotte will cover off in slightly more detail over the course of the next few slides. Conditions subsequent are conditions that have to be satisfied within an agreed period after the lend. They often relate to items that for one reason or another can't be satisfied in advance, or it could be that waiting for them would cause an unreasonable time delay. They could include deliverables, so for instance, the provision of collateral warranties for properties, a letter from an insurance broker, or it could be an obligation to otherwise comply with a deal-specific clause, so for instance, a time delay on a certain covenant or undertaking. So I'll now hand back to Charlotte, who will run through property due diligence.
So the borrower's lender will either instruct their own solicitor to carry out the due diligence process, or they'll jointly instruct the solicitor acting for the borrower. The due diligence process is very similar either way, as the solicitor will have to conduct full due diligence on the property to ensure that there's no issues with it that could reduce its value and affect the lender's security. The solicitor will review the title documents, submit and review the usual property searches that would be carried out when purchasing a property, and they'll ask the borrower to provide replies to standard inquiries. They'll also review any tenancy documents. Some lenders will accept indemnity insurance for no searches instead of requiring that a set of searches is carried out, but this is at the lender's discretion and is more unusual. There's likely to be some specific inquiries that the solicitor will raise with the borrower as a result of all of these investigations. There might be some issues that the solicitor comes across that need sorting out before the refinancing can complete. For example, there might be old leases noted on the title for the property that need to be removed. There might also be some issues for which the solicitor will recommend that indemnity insurance is put in place on completion. For example, if the title excludes mining rights, the solicitor will recommend that indemnity insurance is put in place to cover the risk of a third party coming along and saying that they have the right to mine underneath the property. You'll have to cover the cost of the premium for any indemnity insurance policies. The solicitor will pull all of the information together in a report for the lender, and they'll also do a lease report for any tenancies. The lender will review these reports, and if they're happy with them, then the transaction can proceed to drawing down the loan. The reports will also need to be reviewed by the valuer that the lender's instructed to conduct a valuation of the property, so that they can confirm that there's nothing in the reports that affects the valuation. The solicitor will check this with the valuer before the reports are sent to the lender. So if the refinancing is for development purposes, there are a few extra steps that will need to be taken. The lender's solicitor will want to see all of the planning documents and ensure that any pre-commencement conditions have been satisfied. The lender will also instruct surveys to be carried out in addition to the usual valuation. It's likely that the lender will require collateral warranties from the borrower's construction team, and they may also want step-in rights so that they can step into the borrower's shoes and complete the development if the borrower becomes insolvent, for example. The facility agreement with the lender will include provisions for the lender to inspect at certain points during the development, and it's likely that the funding will be in tranches based on satisfactory inspections. For the last part of the webinar, Ryan and I are going to talk about a couple of case studies that we've dealt with recently. So the first one was an industrial estate refinance that we acted on recently. There were several occupational tenancies at the estate, and we acted for the lender as well as the borrower. Our due diligence revealed a few issues with the property. One of those issues was that a small part of the site turned out to be unregistered. The borrower had owned the site for quite a number of years and hadn't had any issues with this, and the unregistered strip had been occupied by one of the tenants. That meant that the borrower was able to provide a statement of truth to confirm that the unregistered strip had been included in their physical boundary during their ownership. We also advised the lender that indemnity insurance for adverse possession should be put in place on completion, and in this way we were able to satisfy the lender on that point. Another matter that was disclosed to the lender was that a previous transfer noted on the title register for the property referred to restrictive covenants, but no copy of that transfer was available from the land registry, and the borrower also couldn't locate a copy. We recommended that an indemnity insurance policy for unknown restrictive covenants was put in place on completion. We also advised the lender about the tenancy documents that the borrower had put in place, and upon our review, it was revealed that some of the leases hadn't been executed properly, and some of them didn't include the correct names of the tenants. This meant that new leases had to be put in place with the tenants, which caused a bit of a delay and additional costs. This demonstrates that it's important to check all of your tenancy documents before proceeding with a refinance, and also that it's important to get the leases right, particularly if you're going to be refinancing in the future. I'll pass you back to Ryan now so he can talk about his case study.
Thanks, Charlotte. So the other case study listed on the slide was a syndicated residential property development refinance, which is a bit of a mouthful. Meyerson advised a large Northwest-based property developer in relation to a refinance of their development facility. So the new facility was syndicated, which meant that there was more than one lender, and it also increased the available facility to in excess of 60 million. Owing to a new lender joining into the facility, this complicated the negotiations because there was a need to revisit some settled terms, and ultimately different terms were included depending upon which lender the loan was advanced by. Because the facility was syndicated, this resulted in 3 legal teams being instructed, Meyerson for the borrower and 2 other firms for the 2 respective lenders. This meant negotiations were more involved as they were on a tripartite basis, and so ultimately did take longer than anticipated. The facility agreement included a revolving credit facility, and this allowed funds to be drawn as required for a development, and it was then repaid as units were sold. Repaid funds could then be redrawn for new developments, subject to certain conditions being satisfied, and again, this was subject to detailed negotiation. Finally, we were also required to negotiate a full security suite over the property portfolio, which included an overarching debenture, an intercreditor deed, and also subordination deeds to subordinate some third-party debt in favour of the lenders. And so I'll just pass back now to Charlotte to conclude the seminar.